Welcome back to the Money Pig Podcast, brought to you by Goodwin Investment Advisory, where our mission is to lead people to financial peace, independence, and generosity. I'm your host, Reed Trigo, joined again by Justin Pitcock, certified financial planner professional here at GIA. Justin, welcome back.
Man, I can't believe you asked me to come back after the last one.
I know that we had to vote.
It came down to the leadership team's decision.
It did, yeah. Well, we were talking about, some of the performance on the portfolios, and I asked, why can't we just get 1% better every day?
Man,
1% in return every day. Why don't you try to do that in your professional life? Get 1% better every day.
If you had 1% compounding on a daily basis, what would that be what would that be annualized?
I don't know. I don't do public math.
It's probably a good thing.
Yeah. But anyway, so that we were joking around, but I am glad you're back.
Yeah, me too.
Nobody voted. We knew you were coming back. You can't escape.
No, this is always fun.
Yeah. Okay. We want to talk today. There's a good question. People ask, like, especially I think when we get that last kid out of high school, and because I'm here, you aren't there yet, but I've been here, and you know what thought starts to go through your mind? What's my number? How much is enough to retire? Now, you're in the business. You probably figured it out for yourself, but I know that's when it started to strike me. Like, what's my number? How much is enough?
Man, it strikes me all the time, and my kids are 6 and 1.5.
And you love your job.
And I love my job.
I know.
But I want to know that I'm on track.
Absolutely.
So, better to know now than when I'm, 60.
Yeah, but you are weird because you're in the industry. Most people don't do this. They're busy doing their job,
hustling,
whatever it is. Yep. Sure. So wanted to talk about this, because retirement it's a major life transition, requires careful financial planning. You got to figure out if you have enough saved, outline, key factors to evaluate your retirement readiness, stuff like this, right?
Right.
But before we do that, before we talk about it, let's talk about what that word means, retire.
Man.
Because I have talked to Tim, the owner here, Tim Goodwin. Y'all may have heard of him. And I remember him telling me a long time, he's like, the definition of retirement is to be put out of service. Nobody wants to be put out of service.
Yeah, nobody.
Okay.
Yep.
So, and then I'm watching Blue Zones on Netflix or whatever that is. And in Japan, they don't even have a word for retire. They keep active. They keep working in this area. They live forever.
Because they don't want to be put out of service.
That's right. Right. So what is your view of what's retirement mean to you?
So I think you could think of it as the date when you switched from accumulating wealth to spending it.
Does it happen on a dime like that, you think?
Well, I think, maybe there's a stretch where you stopped accumulating and then you wait it before you started spending. But that's, maybe it's the point in time when you start spending your nest egg. And it doesn't matter if you're working or not, but if you start spending from your nest egg, it's probably because you've reached financial independence at that point. That maybe you've pursued a different job based on purpose or enjoyment. And, maybe you're taking a sabbatical or, taking a break.
Practice retirement.
Yes, practice retirement.
I did that one time. It was great. I'm so good at this.
Yeah, we have clients that have taken sabbaticals. They've it's their career 2.0. They took a break for a year, kind of figured out what they wanted to do, and so that's people do that.
Yeah,
but again, going back to not wanting to be put out of service, just think of it as kind of your peak net worth. I think that's a good way to frame it. It's the time when you've kind of moved on. Okay, you've worked your whole life to defer enjoyment. Now we're going to start enjoying the money that you've saved. And so it's that switch. And I think it's maybe healthy to think about money as you worked hard for that. You deferred enjoyment, gratification, right, to save because you could have gone on vacation or bought a really nice car or done all kinds of different things, but you decided to save that. So now we have to cash that in and get enjoyment out of it later, right?
Yeah.
And so I think it's helpful to think about retirement in that frame of mind.
Right? I love it. I love it. And it makes me think about the FIRE movement, the FIRE, financially independent, retire early.
Yep.
Right? Okay, fine. They live on 40% of their income, 30% of their income. They save everything. They live meagerly, whatever, and they get to 35 or 40 and they can totally retire. Well, or put themselves out of service. I think I'm not sure that that's all panning out the way a lot of those people expect. Maybe it is, but I think a better way to think about it is the FINE movement, financial independence, next endeavor.
Yep.
Right.
And for the FIRE movement folks, though, think about all the things they gave up to try to do that. And that's not healthy. But if you think about, there's a triangle of what allows you to have the most enjoyment throughout your life. And there's money. And when you're younger, you generally have less money. As you get older, you get more money. But one of the other legs is health. Your health starts declining the older you get, generally. And then the third leg is time. And as you're, if you're young, you're growing a family, you don't have a whole lot of time, but you've got the health. Maybe you're getting more money. You're maybe starting out, you didn't have a whole lot, but you're building up the money part. You don't have time. You've got health, right? And then later on, okay, kids are grown. You've got the money. You still have the health. And that's when, you start really looking to get the most enjoyment out of that money. Maybe you deferred more earlier on in life, but that's the phase. Okay, you've got the time, you've got the health. Let's enjoy that while you can, because health is going to decline and you're not going to want to do the same things that you used to be able to do.
If this was one of those kinds of podcasts where we pause it and then I just step in with a side note from Reed, here's what I would say.
Okay.
I would say to the listeners, listen to what Justin just said, because that is really the mentality of our advisors here. Justin is a CFP investment guru, knows markets and finances, but he's not talking about that right now. He's talking about right-brained, the feelings, the emotional connection that you have when you're considering these transitions in life.
Yes.
Right.
Yes. Yep.
And so I just want people to make sure they hear that. Just back that up, about 2 minutes, listen to Justin say that again, because it's just so meaningful. And I, as a client here myself, I work here a little bit too, but it's just been super, super useful. And I think clients find that.
But also think of it mathematically, and there's an optimal way to use your money, and you need to have health and time in order to get the most out of your money. If you defer it all till later on in life, you're not gonna have as much health as you do now. So just something to think about.
Amazing. So you would argue that this, I don't even like using the word anymore, the R word, right? Retirement. I know.
What is that?
The next endeavor, the next endeavor stage.
Yes.
It starts when you flip that switch.
Flip the switch.
You flip the switch.
Maybe you're working less hours. Maybe you're working a purpose-driven job.
Yeah.
Versus income-driven.
Yeah, and I do think of books that we've read. What the Happiest Retirees Know by Wes Moss. And
yes.
Man, there's a lot of behaviors that the happiest retiree on the block has that the unhappiest retiree doesn't have and didn't take time to develop. And when you say there's a flip the switch, if we haven't worked for since maybe we're 40 or 45 or 50 and we go retire, boom, all of a sudden social network's gone, purpose is gone, all the things we were used to.
Your wife's not happy.
No. Okay. All right. So I did a pretend retirement one time, you knew. And my wife and I look back now, we were just talking about it a couple of days ago.
Yep.
We were purposeless. I was especially. She still was active doing things, but I could only mow my yard so many times a week. And it really was. I was lacking purpose. There was probably a depression that set in, not really bad, but I mean, oh my gosh, I look now and I'm like, oh my gosh, I love what my life looks like.
I bet your yard looked really good though.
It actually looks way better now.
Does it really? Are you paying somebody?
Yeah, I am. Yeah, I am. But also, a long story. I'll tell you about my yard later. Add it on to the end of this. Okay. So how do we figure it out though? How do I figure out when I can flip this switch from accumulate, save, and that can't be the easiest thing in the world to do. All of a sudden you're like, what? I'm withdrawing? I've been contributing.
It's psychologically, it's really hard to do. And we see it when we work with folks all the time. You've been doing everything you can to build up this nest egg, and then trying to change that frame of mind that you can start spending that, people have a really hard time getting past that. And that's what we're here for. We want to build confidence that, gosh, yes, it's okay to spend that money. And a lot of retirees or new retirees have, it's almost like they've, I don't know, I guess created an idol out of building up this balance. Got to maintain it, because that's what you're focused on. You're trying to build up your net worth for retirement, and then it's like, no, I've worked my whole life to get that balance up there, and we're trying to tell them it's okay to spend it back down, and that's a really hard mental shift. But so, how do you calculate what that number is?
Yeah, so there's like an easy way, and then there's a little bit more complex way. Okay,
and
let's go with the easy way. So
anybody could do this on a time value money calculation or calculator. I use an app called FN Calculators. It's I'm not sure what that stands for. FN, but anyways,
financial calculator. Or something
yeah,
like
it's
that,
a financial app. I downloaded it to my phone. You can plug in the different numbers. It's really easy to use. But first, get a good sense of what your cost of living is. I think it's easier to think of on a monthly basis. So what's generally like, how much money do you need to pay the bills and have fun? All right. So that's the monthly number. Let's multiply that by 12. We get our annual number. Now we need to adjust that to inflation, to that point in time when you think theoretically, I would like to have financial independence by this age, that option to pursue something purposeful, that's fun, that I can work if I want to. Mm-hmm. And so we'll adjust that number up for inflation. If it's 10 years and, adjust it up 10 years, 20 years, whatever that time gap is, we'll adjust it for inflation. So that will tell us the number that you'll need on an annual basis. And now we need to figure out, well, how big does your portfolio need to be to provide that number? And oftentimes we're doing these calculations for planners, folks that like to think ahead. And so they're often tell me they want to retire at 60. Retire in the sense that we've kind of defined here.
Next endeavor. Yeah.
Next endeavor. And so, at 60, you're not eligible for Social Security. Oftentimes, you may have an option to start a pension, but most people don't have pensions anymore. So, they're going to be living entirely off of their savings. And so we're kind of thinking, okay, well, how much do you need? So we adjust the current standard of living up for inflation. I generally use a 2.5 or 3% inflation adjustment.
You don't use 9?
No.
Okay.
I mean, it's, I think we're lied to on the CPI readings. But anyways, I normally use, 2.5 or 3%, kind of get to know the person. Okay, what do you, how do you feel about this? Mm-hmm. And go from there. But for example, if you live off of $100,000 a year, that covers vacation and all that other things too. All right. So I'm just totally making this up. I haven't done the math here, but let's just say in 15 years, you'll need 200,000 to have the same standard of living. So we would then take 200,000, divide that by our withdrawal rate, which we feel comfortable with anything up to about 6%. Mm-hmm. So you would take that number, divide it by 0.06, and that would tell you the size of a portfolio that you would need at that point in time to sustain that withdrawal rate.
And something we've talked about before, by the way, we talk about the 4% rule. It's pretty well known in the industry that that's the amount of the universe of your retirement savings that you should be able to pull out and have that money outlive you. You're kind of arguing, based on some other inputs and very, very good other inputs, that withdrawal rate is probably a little low, and that you could probably call it the 6% rule, but somewhere under 6 is probably safe.
I think probably for most folks that are retiring, they're going to be at their peak spending age. One, because they've got the time, they've got the health, and they've got the money.
They're go-go. They're go-go
They're
retirees.
in the go-go phase. Later on, health is going to decline, some faster than others, right? But you're going to be in the peak spending. Later on, you're not going to want to do the same things that you're going to want to do when you first retire. So your spending, despite inflation, generally stays level at first and then starts to decline, even after inflation. That's what all the data shows. But we all think, groceries are going to go up. Well, yes, groceries are probably going to continue to go up, but you're not going to go on all the trips. You're not going to want to do all the same things that you're going to want to do initially. So your overall spending generally still declines. And there's a lot of data that shows that. So that's why I would say, yeah, you could withdraw 6%. That's I think a good number to start with. And that's a number that, you should probably look at on an annual basis. Okay, is this still looking good if I keep doing 6%?
You can do that if your portfolio is the right size.
That's the right right. Yeah,
So
yeah.
this is not personal financial advice, but it is a guideline that we would share.
It's a good guideline. And so that would, going through that math equation, it would tell you, okay, this is how much I need in order to be financially independent at that particular date and time.
I love it.
And then you can figure out, based on how much money you've already saved, you can figure out, well, how much more do I need to contribute? So in a financial calculator, you just plug in how much you've already got. You'd plug in the assumed growth rate of your investments. Okay, if you're investing in the stock market, maybe an 8%. Although the stock market's average closer to 10, I like to be conservative when I'm doing financial planning calculations. So I'll use like an 8% growth rate. All right, so we plug that in. And using the calculator, I'm able to calculate exactly what that annual contribution would be. So I could tell you, all right, here you go. And this is pretty easy to do on your own. If you download the app, like just plug in a few numbers here, boom, there you go. You know what your annual contribution needs are to reach that number that we just talked about.
Absolutely. So the simple version, even though for a non-financial person that could have sounded complex, but the simple version is this: figure out what it costs you to live every month. Figure it into a year.
Adjust it for inflation.
Adjust it for inflation.
Divide that by 0.06.
That's right. Your distribution rate. And that number will give you what the universe of your retirement savings needs to look like.
Yep.
And we're not even factoring in any pension, any Social Security, any other part-time job. We're not even factoring those things in.
No, that's the simple calculation. Now,
Good.
For our clients, we depending on their circumstances, the simple calculation might be exactly what they need. But for other folks, we need to do a more detailed analysis. That's where we factor in the timing of when their mortgage will be paid off, the timing of when their pension could start, the timing of when Social Security will start, and different phases of life, like when you've hit that purpose-driven retirement and you start that 20 an hour a week job and kind of have this gradual phase out. So we can model all these different cash flows and their timing and illustrate, okay, so here's where you step back. You've been working full time. You've been hustling. What if we just worked 20 hours a week, made half as much? All right. But then, a couple years later, the pension will start. Social Security, we're going to delay till 70. So we've got the timing of everything mapped out. And oh, by the way, your mortgage is going to be paid off when, at this age. So that expense is gone. We model that out in our planning software, and our software can help us actually solve for the maximum amount of spending that you could have. So that's the more complex version. That's where you need to come see us. We do that for all of our investment management clients. We offer to build their situation out in our planning software, and we can do that analysis.
Man, it is good. I actually just did it recently. I've done it a few times over the years as a client here, but it's really it's fun.
I like to do it every year for myself.
Yeah, I bet you do, because this is what you do. That's, of course.
Am I on track?
Who wouldn't?
Yes.
Hey, and as a resource, we on our website, goodwininvestment.com, you can find our guides. It's under our Knowledge Center. We have like financial guides. We have one for retirement and tax planning quick sheet. We have a retirement income guide, and we have 7 steps to planning for your happy retirement. That's a guide as well. So I like to point people to those. They're really, really useful.
Yeah,
to have
absolutely.
Yeah, absolutely. Good. Thanks. That's all. That was awesome.
Well,
Appreciate
I'll
it.
have to drive by and see what your yard looks like.
Oh,
Wish I had a before and after picture.
Stay tuned after this. I'll give you the rest of the story. But as financial advisors, we manage and rebalance portfolios, but the unique value is that we work to understand our clients' individual goals so we can have these types of planning conversations that are so personal and unique to each individual. Shout out to our editor, Noah Davis. Thanks, Noah, and thank you again, Justin. See you next time.
It was fun.
All right.
The Money Pick podcast is hosted by Reed Trigo, a financial advisor at Goodwin Investment Advisory. This podcast is intended to share information and perspectives, but should not be interpreted as legal, financial, or tax advice. The opinions shared by participants are not necessarily endorsed by the company. Goodwin Investment Advisory is regulated by the SEC, and the company operates in compliance with applicable securities laws and regulations.
Okay, so the story about my yard.
Yeah.
Like, I have a pretty big yard.
How many acres?
Well, the whole property is like 3 or something.
Oh, yeah, that's
but a lot of it's wooded, and probably like my backyard might be, I don't know. It's when I mow it on my rider, it's either a 2-beer or a 3-beer mowing.
Dang. That
Depending.
must take a while.
It takes a while. Yeah.
Wow.
Yeah, it's fun. And so that's how I time it. Right. But okay, so we move in, have this fescue grass. This is years ago. And of course, I mow it like it's Bermuda because I mowed it really low.
It's not fescue anymore.
So stupid, it has died. But then it started to come back, and it was coming back. And then somewhere, I don't remember how long ago, maybe 3 years, 2021 or something, army worms came through the neighborhood.
Those things are nuts.
Ate the entire yard, all the fescue. I mean, they ate it all dead. Not the entire, like a huge section.
All the fescue's gone to the dirt.
And mowing my yard, I really do love. I love being outside. I love doing all this work. So then I'm like, what am I going to do? That's way too much to sod. It's ridiculous. I could have probably, but I didn't want to do that.
It'll grow back.
Yeah, so it's been my project for 3 years, and I am almost at the end. I don't know what I'm going to do next, but I got this Pro Plugger 5-in-1. It's like this tube with you step on it, and you step on it, twist it. Look up YouTube, Pro Plugger 5-in-1. Step on it, twist it, and it takes like little 2-inch plugs of grass. So I take it from the healthy sections of my yard, and I plug them about 10 inches apart all over the place.
You'd come back the next day with a mower, it'd be gone.
Army worms.
The grass would be, knee high, as thick as can be, overnight. They would eat it all. It'd be gone.
I've heard they can take out 100-acre cornfield in no time.
Down to the dirt. It's nuts.
Man, that's brutal.
Yep.
Anyway,
that
was extra. We're not even going to charge our listeners more for that.
It's good to know.
Have a blast, Justin. We'll see you next time.
All right. See you, man.
Bye.